Many people have lost big money in the stock markets. Yes, this is a fact. If you look at the stock markets in a shorter time period, it is very risky. But if you understand the behavior and psychology of the markets, you will not find it risky. This is the focus of this episode. Why do people find stock markets risky? Because people usually react. They buy in euphoria and sell in panic. The stock market is very fluctuating when seen over a 3 to 5 year horizon. Usually, small investors buy stocks when the price is very high, almost at its peak, and then they sell when the price is very low, almost at the lower end of the price decline. In many instances, when a small investor has sold out at a loss of the price of the same share would have gone much higher in the next 2 to 4 years. So basically, if the small investor would have not panicked and stayed invested even when the share price was falling over a longer period of time, he would have made substantial profits. We will see this in more detail when I will show you the simple technical charts in the subsequent chapters. Therefore, if you recollect, every time I have mentioned the term investment, law of compounding, or stock market returns, I have always used the term over a long period of time, and I have specifically mentioned the time period of minimum 10 years or more, ideally 20 to 40 years. We all live in a world of constant change, global economy, global calamities, nations at war, terrorism, and now also the pandemic. All these events take the stock market up or extremely low. People tend to react as if the world is coming to an end and the prices crash. But history and statistics has proven this crash in stock prices is always temporary. It could last for 1 to 5 years. The worst of all times is the World War times, where it lasted for 25 years, but that was an exception. Governments have learned a lot in these years. Therefore, even the financial crisis of 9/11 lasted for 4 years. Now, the pandemic crisis of 2020 took barely 1 year to recover and make new highs. Therefore, when you look at your returns over a longer time horizon, it averages out the extreme reactions of highs and lows and eventually keeps going higher. One very strong factor in the above hypothesis is I am buying safe stocks, growing industry, highly profitable, and well managed company stocks. We will discuss this too in a subsequent chapter on how to choose stocks. Now, we can conclude that stock markets that look risky are actually way risky than we think. In fact, if we are patient, if we buy the right stocks, if we do not get carried away with crazy ideas, if we do not get too greedy, and if we look at our investments carefully over a longer period of time, we are safe enough. Now, let me share some interesting examples of investors that have made big money over a longer period of time. As usual, I will talk about the big daddy, Warren Buffett. He started investing at the age of 11. Can you guys imagine that? He bought his first share for $120. He has made a total of $600 billion profits for his investors, and he is worth $110 billion today. 10,000 rupees invested in Infosys in 1993 is worth 80 crores today. Can you imagine that? Infosys shares have made all their peons, housekeeping, and driver staff millionaires. All 66 of them. Mr. Murthy, the founder, told them one thing: never sell your shares. Wipro is another company. 10,000 rupees invested in Wipro in 1984 is worth rupees 600 crore today. Isn't that crazy? Of course, these are exceptions. But in fact, if you stay invested over a longer period of time, you will make good money. And yes, you'll also lose some money in a few shares. Over all of you may win some, lose some money, but the net gain has to be positive. But how do you do that? The golden rule of investing: never invest all your money in one company or in one industry. Ideally, pick the top 2 3 in the top 5 industries and stay invested for a good 10 to 40 years. Rest, the money will do the work for you. But how? My father recently told me an interesting story. Mr. Tim Cook, the CEO of Apple, works 24/7, struggles every day to build his business. Last year, he took home a salary of $98 million. Warren Buffett's company, on the other hand, which is an investor in Apple, took $775 million as dividend income as his profit share from the business without spending a single minute working in that company, almost 8 times more than the CEO of the company. Can you imagine that? That is the power of wise investing and investments in long term stock markets. Have fun and keep thinking about it.